For those of you who garden, you know what it's like to wait for the right time to plant. But what if your harvest could be strong no matter when you planted? That's the environment of today's municipal bond market. Hi, I'm Nate Earle. In this video, I'll walk through what's driving the municipal market and what it means for advisors and clients who are still waiting for the right entry point. I was speaking with an advisor recently who said that they were waiting for the next rate-driven sell-off, something that would create a more attractive entry point for municipal bonds. And historically, that's been a very reasonable approach. But in this environment today, that opportunity may not materialize the way that it used to. We recently saw Treasury yields rise by more than 50 basis points across much of the curve, a move that in the past would have triggered a meaningful overreaction in municipal bonds. But this time it didn't happen. Municipal yields moved higher, but in a more subdued and constrained way. And part of the municipal curve even moved lower. The market showed resilience rather than dislocation. And as a result, municipals have actually been one of the few fixed income sectors delivering their yields through total returns so far this year. So if your clients are waiting for volatility to create opportunity, the risk is that they'll simply miss the income that's already available. At the core of this shift is demand, and more importantly, persistent demand. We're seeing steady inflows into municipal funds and ETFs week after week, even through periods of uncertainty, including geopolitical tensions. Year to date, through the beginning of June, over $50 billion has flowed into municipal funds and ETFs. And that's on top of direct bond buying that we're seeing from retail clients and separately managed accounts. What makes this even more notable, though, is that issuance has been running at a record pace so far this year, and it hasn't meaningfully pressured valuations. So what's behind the demand? First, yields are more attractive than they've been in years. Also, strong equity markets are likely driving rebalancing flows into fixed income. And lastly, and after multiple yield spikes in recent years, tax loss harvesting opportunities have largely dried up. So these forces together are creating a market where demand consistently absorbs supply, and volatility is much more limited than clients are used to. This is the most important part of the discussion because the value is there, but it's not evenly distributed across the municipal market. That uneven distribution of value is due to significant demand concentration and high-quality bonds at the front end of the curve. And that's compressing yields in highly rated, short-dated maturities. So, for example, the 5-year AAA municipal yield is about 2.6%. But after converting that to a taxable equivalent yield by dividing it by 1 minus the top federal tax rate, you get 4.3%. But that means that for even those highest earners, that's only a 10 basis point yield pickup over a comparable 5-year Treasury bond. So front-end valuations are tight. But when you extend out the curve, the picture changes, and it changes dramatically. The 30-year AAA municipal yield is around 4.2% or 7.1% on a taxable equivalent basis. That's more than a 200 basis point yield advantage over treasuries. And then when you move down in credit, BBB rated municipals at the long end are offering roughly 8.7% tax equivalent yields. That's about a 270 basis point yield advantage over BBB corporate bonds. So there is meaningful value in municipal bonds, but to access it, you and your clients need to be willing to go out the curve and incorporate longer duration exposure, whether that is through an intermediate, all curve, or long-term strategy. The question is, what would need to change for this dynamic to shift? Of those key drivers, strong inflows, supportive equity markets, and reduced tax loss harvesting, it's probably a meaningful equity drawdown that's going to have the biggest impact. That could slow or even reverse rebalancing flows and reintroduce volatility. Another potential shift would be a meaningful move higher in yields, something like muni yields moving back above 4%. In the past few years, that's coincided with a 10-year Treasury approaching 5%. So it's likely going to require a significant change in inflation expectations to get there. But until we see those kinds of catalysts, this environment could very well persist. So what should you and your clients be doing? The biggest shift, I think, is going to be behavioral. Waiting for the perfect entry point may no longer be effective. Instead, allocate when funds become available and consider extending duration to capture value where the yields are most compelling. For tax-sensitive clients, the opportunity today is for you to help them begin collecting meaningful income now rather than waiting for something that may not happen. In other words, when the ground is already bearing fruit, don't wait for the perfect season. Start planting and start collecting the harvest. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.